0.5%. In your estimation, they have actually even talked about reducing it in the current financial year by 1% of GDP to about 60 billion shillings. What is this? Do you think the government is committed to this? And what are the ramifications if the government does not take this action to reduce and do some fiscal consolidation and reduce its expenditure?
Obviously, fiscal consolidation is going to be something that the market is going to be looking forward to from the government. If they do embrace it, it's going to be a very positive sign. However, the risk is we are in a pre-election year. It's going to be difficult to actually rationalize wages and salaries. But of course, it could be, quite prudent if they would just postpone some of the development projects forward in order to really tame that fiscal deficit. But importantly, we have to look at what's driving the fiscal deficit. It's the standard gauge railway. And I think as we go on for the next 2 years or so, spending, related to that capital expenditure may not subside. So even though the fiscal deficit would probably, remain elevated, it might be channeled towards productive sectors, which is quite positive for the economy as a whole.
All right. But what about government spending? Something again everyone has mentioned. Even the IMF has said this is something cause for alarm, and there is need for the government to scale back. Given the fact that we're heading into an election cycle, how optimistic are you that we are going to realize this particular venture?
It's very difficult to tell, as you correctly mentioned, but. The government will have a good chance to reiterate the commitment as soon as February when the budget policy statement is announced. If there is some element of consolidation of public finances there in terms of cutting back on spending and slashing the domestic borrowing target, that could send a positive signal to the market. But as you correctly mentioned, the market obviously remains skeptical that consolidation may not come in a wholehearted way as we get into closer to the August 2017 polls.
All right. And interest rates, something that was a concern last year. We saw T-bill rates getting close to 23%, I believe it was. Do you think with the government, planning to issue, with maturity for the government debt, there's a lot of, it's a very heavy year for the government. What is the expectation on that? And, let's talk a little bit about the central bank. Central bank has been talking to commercial banks about lending rates. Also, please give us your perception of that. Do you think we'll see them coming down?
Interest rates, obviously, money market rates are going up at this point in time because of the government's debt maturity structure. So they're pretty large maturities starting from December. We saw that this month in Jan. February is slightly better, but March doesn't get any better. So I think this is currently what's placing upside pressure. However, I don't think it's going to get as dramatic as the last cycle, solely because the currency is more range-bound than it was the last time round. So I don't think the government has the need to get interest rates back up to levels of 18-20%. But of course, as you mentioned, the risk is that if there's no consolidation, then with the large maturities, the upside pressure could persist. And again, it's important for the government to actually consolidate finances to ensure that the rise in interest rates is tapered. Looking at lending rates, we have to remember that, for instance, the 91-day T-bill is an important function of the cost of funding for a lot of banks. So it's important for commercial banks to be confident that on a sustainable basis, on a 3 to 6 month trend, it's not going to overshoot what they believe to be, acceptable. So I think if there is some certainty and stability in rates, that should bode well for, private sector credit. But on the other hand, if interest rates continue to remain elevated, the cost of funding for banks will probably continue to also remain elevated, and that could mean that credit growth to the private sector may not be as rampant as we would like it to be.
What is your outlook for 2016? And what do you think we need to look out for? What are the pitfalls that await us, and what we need to watch out for?
2016, we expect growth to expand by 5.7%. That's up from an estimated 5.3% in the previous year. Now, the reality is that what's expanding GDP is the construction sector, more closely linked to the public investment in infrastructure. What are the pitfalls we have to look out for? The biggest risk to us for the outlook is fiscal slippage. Back to the fact that it's a pre-election year. We need to ensure that we don't grow at the expense of macroeconomic instability. Expansionary fiscal policy could drive growth, but at some point in time, you need to ensure that you're prudent to actually send positive signal to both local investors and foreign investors. So I think that would be the biggest risk for us in 2016. But overall, we're relatively optimistic. I think the negativity that Kenya is being smeared with is not justified at all. I think there is going to be a rebound. The currency is going to be more stable. Inflation may be above target in the first quarter of this year, but thereafter it's going to start to edge down after the onset of the long rain season. So generally, I don't think 2016 is going to be as scary as 2015.
We were speaking to Gibran Qureshi, who was telling us about the economic outlook for 2016. Thank you so much for joining us. He's very optimistic, 5.7%, but says, agriculture might not do so well in the first quarter, but he's anticipating, great returns going forward in the second half as the NSE picks up and as the agricultural sector picks up. Thank you so much for joining us. My name is Adelaide Changole, and it's back to studio.
Thanks, Adelaide. Now, following the loss of cargo and revenue leakage in the country, Kenya Revenue Authority plans on investing in ICT to increase surveillance of goods being transported to other countries in a bid to curb loopholes exploited by crooks, enhancing security of cargo. According to KRA's Commissioner General John Jiraini, the country will see significant changes in the customs sector, and KRA will install a more superior customs management system which will replace the current Simba system that will aid better practices in security management, security targeting and valuation of cargo. KRA is also working on the installation of the new electronic cargo tracking platform that will enable seamless visibility of transit cargo along the northern corridor countries of Kenya, Uganda and Rwanda. The new system will use one common platform for the three countries, enabling the countries to simultaneously track transit cargo consignment in real time. The initiative is meant to have substantial impact on increasing revenue collection and the protection of genuine businesses.
For example, we intend to address through the creation of an online virtual auction platform. So people no longer will need to go to auction.
The average rent for an apartment in Nairobi fell slightly in the last quarter of 2015 for the first time since the year 2000, according to the latest Haas property report for quarter 4 of 2015. The report shows that asking rents for apartments fell by 2.3% and is linked to the rise in land prices, especially in Nairobi. This has seen developers put up many apartments where standalone houses stood in order to make efficient use of land. The result has been a surge in the number of apartments, which now account for 60% of the rental property market. The average rent for 1 to 3 bedroom apartments that are tracked by the index is 72,000 Kenya shillings. The fall in asking rents for apartments in the fourth quarter of 2015 resulted in a drop in rental yields or returns, which stood at 6.29% as at the end of last year. The Haas report revealed land prices continue to rise, but only marginally, and prices in Nairobi increased by 1.3% in the last quarter.
Some spots of high returns, necessitating an ever deeper understanding of the drivers of pricing and of the market itself.
And following the launch of Airtel Unlimited bundles in February 2014, the telecommunications service provider has introduced Unlimited 20 bundle offer for all SMS and data on the Airtel network, targeting Airtel's prepaid customers. The 24-hour valid bundle is packed with 20 MB data, 20 SMSs and 6 minutes of calls to any network. According to Airtel, the Unlimited bundle plans are based on emerging consumer insights and trends that show a substantial increase of data usage for both social and business needs, and are aimed at promoting cost efficiency for voice and data services, growth on the network, and also redefining customers' conversations depending on their varying needs. Airtel has been investing in the upgrade of its network to enhance 3G and 2G quality in the country and hopes that the initiative will add value to its customers. The firm has increased its footprint in the country by opening 18 new customer service shops and plans to add 10 more before the end of April 2016. And also, let's now continue and take a look at other stories. And global oil prices are expected to remain low in the near future, according to analysts, even though the price has lately climbed to about $30 a barrel. The West Texas Intermediate for March delivery moved down $1.85 to settle at $30.34 a barrel on the New York Mercantile Exchange, while Brent crude for March delivery decreased to close at $30 a barrel. Crude oil prices began to recover when the United States faced a patch of extreme cold weather last week, while Europe raised hopes of more economic stimulus measures. However, the global oil price has fallen by more than a quarter since the start of this year, and Iran announced last week that it would increase production since the US and the EU sanctions have now been lifted. In reaction to this news, benchmark Brent crude dipped below $28 a barrel, hitting its lowest level since the year 2003. Analysts also say that the current oil prices can't be seen as the start of any long-term rebound, though the Middle East is ramping up its production levels, and China National Offshore Oil Corporation, one of China's major oil producers, says that it will cut its oil and gas production by between 10 and 25 million barrels this year. It's the first time since 1999 that the leading Chinese oil company has announced such a reduction. Russia's national currency extended its losses weakened by the falling wild oil prices, making Muscovites carefully consider every purchase they make. Russia's ruble slid to almost all-time low against the U.S. currency last week, hitting 80 rubles per U.S. dollar before slightly recovering. The previous all-time low was 80 and 10 rubles per dollar, reached in December 2014 when Russia was in the grips of a financial crisis exacerbated by Western sanctions over the Ukraine crisis. And like during the prior crisis, there was no sign of panicked dollar buying on Moscow streets. Many Russian consumers have spent months already watching the value of the ruble in their pocket fall against the dollar, have also adopted a fatalistic approach to the currency's decline. Last week, foreign currency mortgage holders, whose monthly payments dramatically increased, rallied in front of several banks in the Russian capital, demanding their contracts be reconsidered.
Как на ваш бизнес влияет ситуация с рынком?
Italy and Iran signed a battery of business deals at the start of a visit to Europe by Iranian President Hassan Rouhani, aimed at rebuilding his nation's ties with the West after years of economic sanctions. Heading a 120-strong delegation of Iranian business leaders and ministers, Rouhani will spend 2 days in Rome before flying to France on Wednesday, looking to Tehran's diplomatic credentials at a time of turmoil across the Middle East. An Italian government source said the Iranians would sign up to 17 billion euros worth of deals with local companies in an array of sectors, from energy to infrastructure and from steel to shipbuilding. Many Western nations have accused Iran of funding various terror groups, and despite a landmark nuclear deal between world powers and Tehran last year, the United States is keeping some of its financial sanctions in place because of the alleged terror links and human rights abuses by Iran.
In the next 1 year or so, we should be able to have.
Join me again on Business Today tomorrow. My name is Joy Doreen Bira. God bless.